Hello, I'm Ryan Lightfoot-Brown from Fund Caliber. Today, we're joined by Ben Leyland, the elite rated manager of the JOHCM Global Opportunities Fund. Ben, thank you very much for your time today.
Thanks for yours.
Now, you've talked recently about the market only having first level thinking, that company resilience has been rewarded even if there is no growth, and any company that's been disrupted has been massively punished. Do you think investors are missing something? And can you talk us through your thinking here, please?
Yeah, we describe it as first level thinking, meaning taking things at face value. In investment terms, what that means is extrapolating current trends without maybe thinking any deeper. So a company's doing well, therefore it must be a great company, therefore I should buy the shares. Second level thinking, which we try to employ, would go something like the company's doing well at the moment, but is that sustainable? Or is that performance fully priced into the shares? Or I guess equally interestingly, this company isn't doing so well at the moment, but does that mean it's a bad company? Or is that creating an interesting investment opportunity for me to take advantage of? And given the amount of disruption and what's going on in the world over the last 6 to 8 months, we think that's particularly important. But we think it's wrong to assume that any company suffering disruption is therefore structurally challenged. A good example in the UK is Compass, the contract catering company, a leader in its industry, one of the best balance sheets in its sector as well. Clearly, when people don't go to work, they don't use the staff canteen. But we don't think it's realistic to assume that their business is structurally challenged. We actually think they're in a tremendous position to take advantage of future outsourcing opportunities because the burden on their clients to provide internal catering will be that much higher as a result of health and safety standards increasing.
And that perhaps brings us on to our next question, sort of the breakdown of your portfolio. You have around a third invested in the US, another third in Europe, but you have very little in the UK. Are you worried about the future for UK businesses? Is this the sort of spectre of Brexit rearing its ugly head again?
I guess the first thing to emphasize is that we pay far more attention to where a company generates its cash flows than where it's listed. Generally, we like to invest in multinationals like Unilever or Philip Morris, for whom the listing venue is not particularly relevant to the investment returns you're going to get. Now, incidentally, I'd say that's also true for a lot of stocks listed in the UK, particularly in the FTSE 100. So discussions about whether the FTSE is cheap or expensive often misses this point, and it doesn't necessarily relate to the fact that there is a positive or negative outlook for UK-facing businesses. We actually think the trend of outflows from UK stocks has created more interesting and maybe more asymmetric opportunities in non-UK facing but UK listed businesses. So Compass would be a good example. It's primarily exposed to the US. Ferguson is another good example, a buildings material distributor. Or maybe Rio Tinto or Unilever, which again have most of their economic exposure overseas, particularly in Asia. Now, when it comes to sectors which are generally more domestically focused, say utilities or telecoms, we've often, or certainly at the moment, we find more attractive market structures or growth opportunities elsewhere. So we own a number of US utilities, for example. We like the growth prospects for those, or we like the market structure in the Japanese telco sector more than we do in the UK.
And also in your portfolio, you have around sort of 15, 16% in cash. Have you not found many opportunities of late, or are you concerned that markets have got sort of run away with themselves after the COVID bounce? Or are you sort of worrying about another correction?
Yeah, I mean, the cash balance is currently around 13 or 14%. I guess we should emphasize we deployed a lot of cash during February and March into the falling market. We did that across a variety of new names and also existing names, like, for example, Compass. So at that point, cash got down to around 6 or 7%. But obviously, since then, we've seen a 50% market rally overall. Valuations have become less attractive. And generally speaking, we try to avoid situations where we think complacency is building up. And we'd say complacency is present at both ends of the market, in a sense. Obviously, valuations at the growth end The technology sector in particular have become extremely stretched. There are certain parallels with what happened 20 years ago in the TMT bubble, the technology bubble, in 99, 2000. But you can also see in corporate debt markets how complacent people have become about levels of debt on corporate balance sheets. The fact that sub-investment grade companies can borrow 10-year money for less than 5% is testimony to that complacency, maybe at the lower quality, more indebted end of the market. And so we do think it's appropriate to tread carefully, acknowledge the value available, as I say, in those COVID-disrupted structural winners areas, but maybe anticipate a return of volatility to markets at some stage in the future.
And perhaps following on from that, you're very sensitive to valuations when you're buying stocks, as you've described, whereas the market seems to completely ignore this and just buy the same old growth companies up and up and up. Do you think that the concept of value investing is dead? And how can your sort of quality valuation approach perform in these markets?
Okay, we get asked this a lot. The short answer is no. We don't think value investing is dead. But it probably depends on how you define or how you approach value investing. So there's nothing wrong. Indeed, we still think there's everything right, notwithstanding recent evidence, but there's nothing wrong with focusing on the intrinsic value of a business when you're making investment decisions. We think for long-term investors, the price you pay is a critical determinant of the returns you will receive. That said, we do think that focusing exclusively on stocks that trade on low multiples of maybe earnings or book value is likely to get you into trouble, because it naturally creates a bias towards sectors or companies which are maybe more structurally challenged than average or more highly indebted than average. And we think that's why value investing, or indeed in the UK income investing to a degree, has developed a reputation for this unappealing combination of low returns and high volatility. But if I contrast that approach to value investing with our own, I'd say the biggest difference is the application of, as you say, a quality overlay to a value discipline. And we think that by insisting on buying strong franchises and strong balance sheets, we can avoid those pitfalls, but still apply a value discipline to make sure that we're buying them when we think they're undervalued. And we think by doing that, we'll be able to deliver a much better risk-adjusted performance over a full cycle.
Well, Ben, that's been really interesting. Thank you very much for your time today.
Thank you.
And if you'd like to hear more about the elite-rated J.O. Hambro Global Opportunities Funds, please visit the website fundcaliber.com. And for more from us, don't forget to like and subscribe to stay notified of all our new content.